Hello and welcome to the latest Meet the Managers episode with nestegg. And of course, I'm joined with Chris Andrews, who is the CIO and familiar face from Trobe Financial. I think it's very interesting in these times that you're also staying very safe and well during these unfamiliar and changing times. And I think without further ado, Chris, it's great to have you back on this episode to really run us through some of the ideas of what we have been seeing and really also as well where the Trobe Financials sit in this and their own mantra towards this idea as well. So without further ado, welcome to the show.
Thanks, David. Really good to be with you as always. And I should observe to all the team at Momentum Media, our thoughts are with you. We hope things are going well for everyone at the crew, all the crew, in this very difficult time.
Thank you so much. And I think that's it is one of those things where just seeing all the compassion and the care from businesses, your colleagues, your friends, and your family has just been outstanding across the world at the moment. And I think that's something which has been a silver lining to this crazy time, at least. We're lucky as well, if you all haven't noticed, we're joining you from the comfort of our own home as well, just because we want to make sure that we're delivering news across nestegg and general across Momentum Media as efficiently as possible. Look, the news never sleeps, and I think readers are ever more have ever more the idea of wanting to understand exactly what's happening. So I think, Chris, the best way to kick this off and really maybe more of an open discussion around this is current sentiments within the markets. And of course, the reaction that we're seeing across with some of the major indices around the world have been, let's be honest, heavily hit and continue to have major uncertainty. I want to get your thoughts on that and really where you sort of see that happening and coupling over the last few weeks and months.
Yeah, it's a really, really interesting time and a difficult time, challenging time for investors, David. One way of looking at this is to contextualise it against the longer term. So yes, we've seen the stock market drop from heading towards 7,500 down into the 4,000 range, and now it's just back up into the 5,000. So we're sort of now between 5,000 and 5,500, and seem to be sitting there for the moment. I'll start by making the observation though, is that's still about 25% down on the market peak prior to the global financial crisis. So here we are 12 or 13 years down the track, and investors are still, if they've stayed in stocks throughout, are still seeing capital values down by about 25%. Now, that's not to say that stock markets aren't a terrific long-term generator of wealth. We all know that they are. But it is to say that investors need to balance their portfolios carefully. In an episode like the current one, what we're seeing just reminds investors that capital losses in the stock market can endure for very, very long periods of time. In fact, they can extend really beyond the lifetime of individual investors. So that sort of volatility obviously places investors at significant risk of permanent capital losses. They may be having to draw down on stocks to meet living expenses. And of course, that means they're locking in capital values well below what they're expecting to see from their share portfolio. Now, that doesn't mean abandon equities, but it does mean that investors really need to focus on portfolio construction and, if you like, ensure that their portfolios have proper exposures to capital, stable, income-producing investments, because that's the sort of investment that can really perform for investors through these times. And certainly, David, I know you and the nestegg family will have heard me speak on these themes many, many times before. And what we're seeing now really is a prime example of one of those moments in the market where investors really should be thinking about portfolio construction. And those investors who have taken that seriously over the years are seeing significant benefits.
Yeah, for sure. And I think, as you just mentioned, it's the consistency in your message across from Trobe Financial, which has been ever more profound and consistent across in these times. And you're correct. It has been something which we personally discussed together a little while ago as well. I think also, look, we're lingering on the effects of COVID-19. We still have much uncertainty with this. And unfortunately, I'm not, and I don't think you are even a health expert on where this goes. But what we do know is that the lingering effects of uncertainty from something like global pandemic, which is, let's be honest, came out of nowhere and was very uncertain, may have an effect on the fact that Australia, for example, on our own soil, hasn't seen a recession for almost 30 years. And now I think with something like this, which can happen very quickly, we may, or, I think have the idea that there could be something on the cards potentially in the terms of maybe a longer, more lingering downward effect.
Yeah, David, so we think of what's going on at the moment really in three phases. You're right. We're in a sort of a Rumsfeldian known unknown situation in the sense that we know what's causing the problem that we're facing as a global community at the moment, and that's the coronavirus. We're starting to get a sense of the policy mix that can be helpful in containing it, but we really don't know how that's going to play out over the next 6, 12, 18, 24 months. So there's the known unknown. When we think about that and lay that across the economy, what we're really thinking about what's going to happen over the next few years as being in three phases. So phase one is where we're at right now. That's the hibernation phase. Social distancing, a phrase we hadn't even heard of 2 months ago, is suddenly what we're all living and breathing, not just here in Australia, but across the world. So what are we seeing there? Well, we are seeing a really severe economic contraction. So the IMF are projecting that Australia's GDP will be down 6.7% this year. That's about where we're pitching it to, and it seems to be the growing consensus of economists generally. The second phase, and we're expecting at this point, given the good news that we're seeing in Australia, is that we will start to see that in the third quarter this year, maybe even as soon as a month or so from now. But certainly what we're going to see is the economy rebound. So that will be as the lockdown restrictions are reduced and people will get back to work. There's no doubt that that's going to be a significant improvement for the economy. You're going to see shops, cafes, progressively restaurants, and so on, all gradually move back towards business as usual. My only word of caution there, you look at the IMF projections, they're projecting that Australia's GDP will actually increase by 6.1% next year. To our way of thinking, that's a pretty bullish projection. We don't think that in this initial recovery phase, the economy is going to get back to pre-coronavirus peaks. That's the work of the third phase, what we're calling the restructuring phase. So in the restructuring phase, economies across the world, they're going to be reassessing all the imbalances that have been made evident by the coronavirus. They're going to be reassessing supply chains. There's the risk of some excessive economic nationalism creeping in, so that's going to be a theme to watch. And broadly speaking, this is going to play out across the world. For policymakers who have ambition, who have courage, there will be the opportunity to lay a foundation for the next generation, really, of economic growth. So that's the challenge that all nations, including here in Australia, are going to be facing. And the one silver lining about that for Australia is we're already starting to hear the first murmurings of economists, policymakers, academics, investment managers starting to talk about those themes. We're not getting ahead of ourselves, but it is important that we do a lot of thinking now so that when the moment is right, we can build that base for continued long-term prosperity. In terms of recession, there's virtually no doubt that Australia will go into recession. So our nearly 30-year run of uninterrupted economic growth will be broken. On the flip side of that, it took the coronavirus to do it. So while there are always naysayers, Australia's economy has been robust for a very, very long period of time.
Absolutely.
Yeah, there's cause for caution, but also longer term for optimism. As the Governor of the Reserve Bank said just this week, David, the fundamentals that have driven Australia's economy forward over the last 30 years, they are still in place, and they will still be in place post-coronavirus.
I think that's a really important thing for investors to retain the knowledge on as well. And like you said, another thing that I found really interesting what you just said there was the change in terms of how the market breathes. And I do see it as almost a living, breathing thing. We're going through this massive exhale of air at the moment, and then there comes the inhale, and things start to come back to normality in some aspect. Now, as we all know, the famous line, history never repeats itself. But I do think looking at those historic factors of where those recessions have taken place across the world and how they recover, and the fundamentals essentially with Australia and what we're known for doing fundamentally in our infrastructure, recovers that across as well is going to be a key component to that recovery later on down the line. So it's really interesting that to see that estimated inflation swing. But like you, I'm not surprised, and I think that we're also, as much as hardship is probably around the corner, and I agree with you there, I think there is also that silver lining that is in the future as well. Chris, I wanted to get a bit of an idea as well in terms of historic events and how investors prepare themselves. Now, consistency is king, and I think that's something where looking at a portfolio as such should match that ethos as well. Now, we've already discussed lightly in terms of where you've been having the mantra from the Trobe Financial to obviously be consistent and helps provide investors with reliable monthly income. But I wanted to get a bit of an idea in terms of the team aspect as well. How do you work with your team during these times where you're not necessarily in the same physical office together, but you're very much in conversation, I'm guessing, most days?
Yes, it's a really interesting point. We've been very pleased actually with the way our business continuity processes have played out. It is fair to say that I think most businesses across Australia hadn't planned first and foremost for a business interruption event which would involve no secondary site, in the whole team being dispersed, to their various individual homes. So it, for us, has been really pleasing to see the way all our online platforms, the way our core operating systems, and really the connectivity to the team has continued throughout. It's been really pleasing. I think, David, one observation I'd make though is that we are, as an economy, really fortunate that this has happened in 2020. Even 10 years ago, even through the global financial crisis, had we faced an event like this, I just do not believe that the Australian economy, or indeed any economy across the world, would have been able to operate. We're hamstrung at the moment. That's true as an economy generally. But so many businesses like the Trobe Financial, we are able to continue in frankly, a seamless way. And that just wouldn't have been possible 10, 15, 20 years ago. So I think there are some things that we should be grateful for, certainly around the timing of this coronavirus event.
Yeah, you're right. I think in terms of the infrastructure that we have now set up, and you're absolutely right, in terms of even a decade ago, this probably wouldn't have been able to exist. So it's amazing to see the connection between teams such as yourselves and the ongoing, and this goes for us as a publisher as well. It's amazing to see how we can work, if not more efficiently sometimes, with concerning issues among us as well. Concerning issues also bring me to my next question, Chris. There's a lot of panic and hysteria just in general. There's a lot of, like we say, uncertainty sort of breeds that panic and hysteria across into the market, and it kind of flows into our everyday lifestyles. How would you, or what would you sort of look at in terms of, for the investor out there, when they're looking and recalibrating their daily life and their daily portfolios, how can they best themselves, or at least stand out of the crowd to not follow that bandwagon of panic and hysteria?
Yes, I think the first thing investors need to be really comfortable with, David, is that volatility is here with us to stay for a while. Now, right now, the stock market is, as we've seen, it seems to be recovering a little from its lows. But really, there has been no factoring in by the market of the fact that company incomes really across earnings, if you like, across the market are going to take a savage hit at least this year, and some companies probably won't survive. So the impact that on portfolios, I don't think that's been priced into markets. That will be progressively priced in as we get a better view of what's happening in the economy. That'll be priced in over the next 6 to 12 months. So investors need to be comfortable with the fact that volatility is here to stay. Now, there are some obvious responses to what we're seeing at the moment. Firstly, investors shouldn't be relying on dividends. I know that has been, in the income space, a popular strategy for many years. Investors be well and truly aware that in the case of banks, there's a regulatory overlay. But for businesses everywhere, earnings are under pressure, and dividends they can expect across the market to be cut quite savagely. That's, I think, a reasonable premise for investors to be operating on at this point. I just go back though, David, and I don't want to sound like like I'm on repeat here, but the only approach that investors can take to mitigate risk in an environment of uncertainty, which is really the environment that every investor operates in at all times, right? The only sensible approach is to diversify.
Mm.
No investor can say right now how this coronavirus impact is going to play out across all the various sectors of the economy. Who would have imagined, for example, that toll roads would be hit so hard because traffic has gone off the road? No one really factored that into their assessment of those types of infrastructure assets. Didn't we always believe that, well, the airports would always be busy? Well, now the airports aren't busy and won't be busy for some time. Now, obviously, those are still very important and fundamental assets to the Australian economy. But the only way that investors can prepare for the black swan events, or the grey rhino events, as some call them, the events that we absolutely know are coming, we're not sure when, but we know when they hit us, they're going to hit us hard. Investors absolutely know that those events are coming, and the only sensible way to prepare for them is to stay diversified.
Yeah. Absolutely. I think that's in ever more something, and you haven't been repeating yourself. I think it's just as important as we have been discussing across the board more than ever. It just shows that mitigating risk and managing that risk really does have a longer impact on how we do things and how we work as an investor as well. I also think, look, let's be honest, the Trobe has been working consistently producing income for their investors since 1952. You have seen these black swan events. It's not abnormal to the company to live and go through and consistently work through them productively. Now, I really like that approach that you've got of being consistent and having that diversification top of mind. Now, that mantra now seems more evidently clear that it's just as important as usual, but I'm going to ask a question which I think I know the answer to. I can't see that mantra changing in any time soon, and I think that's something which you'd probably be quite proud of at the moment to own.
So, David, once every 10 years or so, we at the Trobe Financial, we become the flavour of the month. And certainly when investors look at the market volatility, they look at the consistent, stable return profile that we've been producing for investors across all these cycles, as you say. We're aware that this sort of strategy doesn't have, what would you say, the sexiness, the excitement of some of those strategies, and that's fine. I mean, we're not saying there's not a place in investors' portfolios to have a flutter on an afterpay or whether the company that you identify as the next big thing. But we say those sorts of risk exposures have to be balanced with something that's going to perform for you across the cycle, something that's going to preserve your capital. I mean, preserving capital. Losing capital is the cardinal sin of investment, certainly in our view. In the view of someone like Warren Buffett, he says there's two rules of investment. First, don't lose your money, and second, don't forget the first. That's so fundamental to our view of investment. And you're right, it looks stunningly incredible once a decade or so, but we think our return profile justifies that approach across the whole cycle. I mean, investors in our 12-month term account at the moment, David, are getting 4.7%. Now, it will surprise no one to know that given how low interest rates across the economy are, that is actually the lowest rate we've ever delivered in that strategy. That's the sort of, it's been going nearly 20 years now. That is the sort of consistency that we're trying to produce for investors. And we think it's got a place in frankly, every investor's portfolio.
Absolutely. I think it's interesting as well, sort of, and you're quite right, looking at those interest rates, especially in a downward market, we haven't really got the interest rates to rely on for another sort of drop to take that weight. If anything, there is a possibility, as some countries, such as in Germany, where they've already gone into some level of negative interest rate, which essentially is, for us, is the privilege to store your money in a savings account. So it's incredible to see that your model is working through that, and of course, producing that yield and that income throughout these times. Chris, I know that we don't have that crystal ball to look into the future or really sort of a clear idea right now in terms of where things can be quite sustainable for the future. But I think that it would be quite interesting to get your take on a slight outlook. I know that we are looking at some dire times potentially ahead, but I always like to have that kind of long-term approach in terms of how I educate myself, how I look in the market, the way I look at it, and the mindset I take onto it. So have you got some really sort of more sort of round up outlook in terms of where things are at?
Yeah, in terms of an approach to investment in this market, David, it's we are strongly of the view that most of the art of investing is the art of controlling your mentality. What drives these peaks and troughs in markets, really across asset classes, is the greed and fear cycle. We've seen that again and again through history, and really, I think every serious investor, certainly every listener to and viewer of Nestegg, would be well familiar with that paradigm. That's a fundamental behavioural driver of markets, David. And so the first thing investors need to be thinking about, again in this environment of uncertainty, is controlling their mentality and sticking to the fundamentals of investment. If you see a particular opportunity in the market and as an investor you're very comfortable with it and you want to take on that exposure, by all means do so. But remember to keep balance in your portfolio. What's going to support your income over the next 2, 3, 4, 5 years? Remembering when we think about our view of the economy, so we're currently in the hibernation phase, we're expecting to be moving into the rebound phase. Now we know in the rebound phase that a few things are going to happen. Firstly, there's going to be much more activity going on. It's going to feel a lot more like normal. People will be in the streets over time. Hopefully cafes, restaurants will open, the kids will be back at school. The people who are trying to work from home and educate their kids will finally get a break. We're not going to be traveling overseas for a while. So all of these sorts of things have impacts on particular sectors, on particular industries, and on specific people's livelihoods. So then we think about what happens through the restructuring phase and what could the shape of the economy be over the next 3 to 5 years. And my point about that, David, is really that is a classic unknown. We can't for sure which sectors of the economy are going to be really, really strong in 5 years. We have a sense that healthcare, but in what shape and what part of the healthcare sector will be really strong? Infrastructure sounds good, but there's been a black swan for infrastructure too, as we've discussed in the case of ports and airports and toll roads, all experiencing a hit that probably wasn't in any of their stress testing and modelling before this. So again, what's the reaction of an investor? And this is what we keep coming back to in all our discussions, David. What should an investor do? Stay diversified. Don't lose your nerve. You can't get yourself out of the markets altogether. You do need to generate portfolio returns to build towards retirement savings, or if you're in retirement savings, for income on which you can live. You do need to continue to do those things. But remembering the fundamentals of diversification, that is just a fundamental lesson that all investors need to hold very carefully to over the next 3 to 5 years.
Absolutely. Chris, I think we've covered some really important and worthwhile topics across on this conversation. And I could talk about this all day. Honestly, I've got so many other questions around this impact. I'm sure a lot of our listeners out there do as well. For now, Chris, I will have to say thank you very much for joining us on this episode. It's always a pleasure to have you in the studio, or at least in my home studio, as you are at the moment. And of course, looking forward to the next one.
Thank you, David. Best wishes to you and all Nestegg viewers.
And for you out there listening, thank you very much for watching the video. I hope that you've taken something across, even if it's just the smallest idea in terms of how you can restructure your own investment portfolios in the current times, and the way that you can change, as Chris mentioned, the mentality of how you go into the volatile markets also. I also want to say, if you want to follow any of the information that Chris has been discussing, you can click on the links below, and you can also follow us directly at Nestegg across our social media outlets, and you can also get in touch with me at editor@nestegg.com.au. Until then, stay healthy, stay safe, and it's great to have you with us. See you in the next one.